Dear investors, Prasenjit Paul here. So today I'll discuss about one of the most common thing in equity investing, like what should an investor do if one of the stock price in his portfolio keeps falling. So many times investors remain confused, many times they average out the stock or they just keep holding the stock. So let's have a look what should you do, and at the same time I'll discuss about the importance of portfolio allocation. See, since 2010, I have interacted with thousands of investors, and what I noticed is that maximum investors prefer to average out or to buy more shares if any of the portfolio stock price keeps falling. Primarily, the reason that I learned from them is like if you keep averaging the stocks, your average purchase price will come down. So here I have just made a chart. So say for example you have purchased a stock at rupees 350 shares in the first purchase. So at this stage in the first purchase, your total purchase value, it's simply 50 into 300, that's 15,000, and the purchase cost will be 300 rupees. Now let's say the same stock price comes down to 200. So many investor, what they think, okay, so now it's I had purchased at 300, now it is 200, so valuation wise it might be more attractive, so let's purchase more to average the price down. Yes, if you again purchase 50 shares at 200 rupees, then now your total purchase will be worth 25 rupees. Earlier you had already purchased 15,000, now 50 shares at 200 rupees each, 10,000 means 25,000. Then your average purchase price will become 25,000 divided by 100 is 250. Now again, if the price falls to 100 rupees per share, again if you purchase, obviously your average purchase price will fall much down. So now your average purchase price will become only rupees 200. It's simply you had purchased thrice, first 15,000, 10,000 and then 5,000, the same quantity. So your average purchase price will become only 200 rupees per share. But the point is, let's say you have a overall portfolio size of 1 lakh. So in this process, first, as you have purchased 15,000 worth of shares, your overall portfolio allocation would be 15%, 1 lakh, 15,000 of 1 lakh would be 15%. Then from there it would increase to 25%, and then it will increase to 30%. Now let's have a look at the impact on overall portfolio. So suppose the stock ABC Limited in your portfolio drops by 50%. See, if you are in the stock market for 5 to 10 years, then sooner or later it must happen that one of your portfolio stock might fall this much percent or even lesser, whatever the strategy you apply. Now let's have a look what would be the overall impact on your portfolio in 3 different cases. In the first case, I have considered the allocation of only 6% of that ABC Limited. So 6% allocation means if your overall portfolio value is 100 and ABC Limited would be worth only 6, and 50% fall in ABC Limited means this 6 will become to 3. So if the 6 becomes 3 and I am considering the remaining part, the remaining portfolio value remains same, like the remaining value will come 100 minus 6, 94. Then the total loss, what would be the total loss on your portfolio is only 3%. So as the remaining 94 remains as it is and the 6 becomes 3. So it's simply 3 plus 94, 97. The total overall portfolio value becomes 97, and then overall portfolio loss will be only 3%. In case 2, if you increase the allocation, remember, while you are investing more or while you are purchasing more while the stock price keeps falling, you are also increasing the overall portfolio allocation on that particular stock. So if the allocation becomes 20%, then the same ABC Limited was purchased worth 20 rupees and that 20 becomes 10, 50% fall. And again, if I consider the remaining portfolio value, remaining means 100 minus 20, the remaining 80 remains as it is, then the total loss will become 10%, because now 20 comes 10 and the remaining 80 remains as it is. 10 plus 80 equal to 90. In the overall portfolio value turns 90, the overall loss is 10%. In the third case, if I consider the allocation is 50% of the overall portfolio value, so you had purchased ABC Limited worth 50 rupees, and in case of 50% fall, this 50 turns to 25. Now again, if I consider the remaining portfolio value remains same, so 100 minus 50, the 50 remains as it is, then the total loss on 100 comes 25%, because 50 turns to 25 and the remaining 50 remains as it is. So 25 plus 50 is 75, 100 rupees portfolio turns to 75, then the total loss comes at 25%. Interestingly, it is not a particular stock that decides the overall portfolio loss or profit. It is the allocation that decides the overall portfolio profit or loss. So in this chart, I have summarized if the same 50% loss in a particular stock, and if that stock have only 6% allocation like I have mentioned in the first case, then the remaining portfolio, the remaining portfolio value is 97, the remaining portfolio value of 94. If the remaining portfolio 94 generates only 10% profit, so only approx 9 rupees profit, then the overall portfolio turns into a 6 rupees profit, because 9 plus 97, it would come around 106. So in your overall portfolio, it would be 6% profit. Now, if the same allocation turns 20%, a 50% loss stock have the 20% allocation in your portfolio, then the remaining portfolio, the remaining 80 rupees needs to generate 20% return for the same 6% profit in the overall portfolio, because the 20% allocation stock already becomes 10 after the 50% loss, and the remaining portfolio, that's 80 rupees, need to generate at least 20% return. I mean, if the 80 rupees generate 20%, then it will become 16 rupees, then the 90 plus 16 will turn 106. So the remaining requires 20% profit to generate the overall 6% profit in the portfolio. Now, interestingly, if you have the 50% allocation on the particular stock which lost value by 50%, then let's have a look how much you need to generate just to recover loss. So the remaining portfolio value, the remaining comes 50, like as you have 50% allocation on that loss making stock, the remaining portfolio of 50 needs to generate 50% just to recover the loss, because unless and until you can generate another 25 from the another part of your portfolio, you can't generate at least overall profit in your portfolio. So now the things are clear. The more you average down, the allocation keeps increasing, and as the allocation and a portfolio keeps increasing, this is also increasing the overall portfolio loss, which means it is becoming more and more difficult to generate overall portfolio profit. Remember, it is the overall profit that matters. It doesn't matter whether you earn 100%, 200%, 300%, or lost 50% from a particular stock or not. At the end of the day, it is your overall investment that decides, that will decide how is your portfolio performing. So here, clearly, the more you average down a particular stock with falling stock price, although the average purchase cost comes down, but in this process, the overall portfolio loss is becoming more and more, and it's becoming more difficult to generate overall profit. As I do many portfolio reviews, so I have noticed this same example, the same phenomenon on multiple portfolio of multiple investors. Since 2010, I had noticed similar thing in the stocks like Suzlon, Educom, Reliance Power, IVRCL, and many more. And latest, I have noticed the Yes Bank. So here I have just listed down, just 1 month back, I was reviewing a portfolio of an investor, and I noticed the stock Yes Bank consists around 50% of his overall portfolio. His portfolio was around 10 lakh rupees, and what he did, he first purchased Yes Bank at May 2019 at around 150 each, so that was worth around 1 lakh rupees, and at that time there was a 10% allocation. And then after that, what happened when the Yes Bank dropped from 150 to 90 and then 90 to 60, then he thought that okay, the Yes Bank that was the fourth largest bank in India, that is not to permanently stay at rupees 60, so he averaged out more. just to bring down the average purchase cost. And again in June 2020 he purchased 1 lakh worth shares around 30 each, and again in August 2020 twice he purchased, once at rupees 12 when Yes Bank came out with the FPO, and then again at 15 rupees. Remember, after during this June 2020 SBI invested a lot on Yes Bank, and that time the investor was sure that Yes Bank is not going to shut down the shop, so the bank will recover sooner or later. So he invested more, he had invested 3 lakhs in June to August 2020, because that process will brings down his average purchase price, and he has a strong belief that Yes Bank will never shut down. Yes, it's true that Yes Bank will never shut down, but in this process what happened, his 5 lakh investment, he successfully brings down the average purchase price of 54, but still at current market rate of 14-15, it's still the overall investment is still at 70% loss. Now interestingly, to recover that 70% loss, remember in a 10 lakh portfolio, if you have a 10 lakh portfolio, 5 lakh investment is showing 70% loss, then the remaining 5 lakh must show 150% profit to make a overall profitable the portfolio. So this is becoming very difficult to make his overall portfolio more profitable. Now remember, he has a strong belief that the Yes Bank will never shut down. Yeah, I also do believe that Yes Bank will never shut down. Yes, there is a possibility that after 2 years, 3 years, or after 4 years the stock price might again reach to 50-60 level. But remember, even if after 2-3 years the stock price reached to 50 level, this will be a huge opportunity loss, because after holding this 2-3-4 years you are just coming to a cost price. You are avoiding the loss, but it just recovers your cost price, and which in technical terms we call in a opportunity loss. It means if the same amount invested in another quality stock, it might have generated much better return. See, in this case the required action should be, whenever a stock that's Yes Bank falls from 150 to 160, instead of averaging it more, if we had booked loss and reinvested that amount in elsewhere, yes, from 150 to 160, it would have been a huge loss. But if he booked that loss and invested elsewhere, then the chances of recovery would have been much higher instead of this averaging down. You must have to remember that if you are in the stock market for 5-10 years, that at some point, no matter what strategy you will apply, at some point any of your individual portfolio stock must suffer loss. But it is not a 1 or 2 stock is showing loss, it is the how much allocation you have in your overall portfolio on that particular stock that decides your overall gain or loss. So to conclude, what an investor should do, never ever keep averaging a stock if the stock price keeps falling, until and unless you are 100% confident and sure that the price will fully recover within 6 months. So again, I repeat, because that's a very important thing. Many investors I have noticed keep averaging, thinking that my average purchase price is coming down, without thinking that the portfolio allocation is keep increasing. So again, I am repeating that never ever keep averaging any of your portfolio stock while the stock price keeps falling, until and unless you are sure and 100% super confident that it must recover within 6 months. Sometimes it happened, say for example during this COVID-19 pandemic in March, irrespective of the quality, all stocks corrected by 30-40%. So those are things are different, but in general situation, if a stock price keeps falling by 30-40-50%, you should not average just because the stock price keeps falling. You can average only if you are 100% confident that this price will recover for sure within 4, 5 or 6 months. So this is the reason that in my portfolio, if you visit my website www.prasenjitpaul.com, you'll notice I have offering a service called Follow My Portfolio, wherein along with the stock I also mention what is the allocation I am holding in my portfolio. So earlier I used to offer the stock advisory, stock tips. In the stock tips model, the only drawback is you, until and unless you are sure about the allocation, you can't make enough impact on your portfolio. Now in Follow My Portfolio service, along with my purchase or sale, I also provide allocation. So that one can get a clear idea what kind of impact can have a stock, whether it's making profit or loss. So always remember this thing, never ever average a stock while the stock price keeps falling. Always remember the opportunity cost, and always remember in the process of averaging down, you are actually increasing the chances of overall portfolio loss. So as of today, that's it from my end. Wishing you a happy and investing journey. Stay safe. Goodbye. I'll come with another interesting video. Until then, stay tuned. Thank you.